as a DIY investor. DIY means do it yourself. In your primary market investing, you are purposely, as an investor, approaching the primary market as a person, as an individual. Your success in this investing will greatly depend on your ability to analyze the information given and the market. Your ability depends or is measured by the amount of information, basic investment information that you have as a person. Today in this video, I want to give you basic insights that we rely on in understanding the opportunity that is before us and in choosing which instrument to purchase, and purposely for what reasons. I will focus on those insights after 3 seconds break, so don't go away. Subscribe to the channel if you are new and share this video to another person because it has value. See you in 3 seconds. Insight number 1 is the market interest rate. As an investor, all the time you want to purchase a bond, always make sure you know the market interest rate. That may sound tricky, but this is how you tell the prevailing market interest rate. Check from the same platform, because CBK is a regulator, is a financial market regulator. They formulate the fiscal policy and the monetary policy. The fiscal policy is about taxes, and the monetary policy is about interest rates. And how do they determine, or how do we tell the prevailing market interest rate? Is by considering the coupon rate or the interest rate on the 364-day Treasury bill. So you go to the Treasury bills, and the coupon rate, the interest rate of the 364-day, the longest Treasury bill, that is the market interest rate. So compare that market interest rate with the interest rate that is offered in the security or the bond that you want to purchase. Why is that one important? That is what excites demand. And the question is, if the market interest rate is higher than the coupon rate for the instrument that has been floated for sale, why do you think people will let go a higher interest rate to purchase an instrument that is giving them a lower interest rate? Or we all go for the highest interest rate? So, when it is the case where the market interest rate is lower than the interest rate in that coupon, you should know that there shall be a higher demand. And for that reason, that can necessarily increase the price on that instrument because of bidding. But where the instrument floated as a lower coupon rate to the market interest rate. A good example is the IFB1 2023-17, which is giving 14% when the market interest rate is at 16.5. That categorically is what is reflected in the schedule of pricing, this part of the prospectus. You notice that the prices or the clear price or on the prospectus begins with 90, meaning that for every 100 shillings, you are paying 90 shillings, meaning that you are getting that instrument at a discount. The reason is there is little possibility of individual investors purchasing this bond because it has a lower coupon than the coupon in the market. So basically, I would rather buy the instrument, the bill, treasury bills, that is giving me a higher rate compared to this instrument that is giving me a lower rate, because as a basic investment information, we look at the coupon rate. If you look at the IFB 2023 6.5, it is at 17.9 when the market rate is 16.5, meaning there is a huge demand for that instrument. And obviously, because we all go for a high coupon rate, then definitely the price, if you look at the same part of the prospectus, the pricing, if you compare the two, the pricing for the 6.5 seems to be higher than the other one, the clear price, because the instrument is giving you a higher return than what is in the market. That part, the importance of it is on the demand and the pricing. And the most important element when it comes to the pricing and the coupon is the yield. The yield is difficult to be determined by an ordinary investor because it's a product of the bidding process, which comes after the auction is closing. And therefore, it is highly recommended that you bid non-competitive. Don't choose a rate. Bid uncompetitively. And for purposes of that non-competitive bidding, the maximum amount an individual can bid non-competitive is 50 million. So you have all the room. The minimum for competitive bidding, risk bidding, is 2 million. But you are allowed to invest to a maximum of 50 million non-competitively. But beyond that, you are not allowed to go non-competitive. You should bid competitively. That said, we have the second important insight in bond investing, and that is accrued interest. Accrued interest, to accrue means to accumulate. And accruing means, or we look at the last coupon payment date. Because the interest accruing, or the interest earned on these instruments, is accrued on a daily basis. It is pegged on time. If the instrument on offer is a reopened bond, it means that from the date when the last coupon was paid to the date when payment for the bond, not bidding, payment will close, that period interest will still be calculated or will be accumulating, accruing to those who are holding that instrument. And for that reason, to be held at par with the initial investors, this interest that is accruing or getting earned for that period is supposed to be purchased. It will be purchased by the new bond investors so that they are maintained at the same level with the older investors in the original bond. So when you are paying for that instrument, you will obviously pay a price that is higher than the face value of the instrument. That additional amount, the accrued interest, is what makes the price change name to a dirty price. So dirty price is not a unique, is not a technical term in the market. It's an addition. This element that is added, the accrued interest added to the face value or the price, the par price of the bond, that is what makes it now be assume a new name, a dirty price. And the good thing with it is that immediately in the next coupon payment, you are going to be paid the whole interest amount. So you are giving it and it will come back to you. While we are at that point, there is the question of the market interest rate and the coupon rate in determining the price, because it can either be a discount, you are at par, or a premium. So at the resultant price will now be pegged on the par price, then the difference between the market interest rate and the coupon rate and the accrued interest to a resultant data price that we are supposed to pay. The other important insight is the element of discounting and compounding. Those two terms sound difficult, but discounting is the opposite of compounding. Compounding is very important for one to understand that when you are applying the 72 rule, which determines the period of time it shall take for the amount that you have invested to double. If you are putting in an investment of 100,000, when you use a 72 rule, you take 72 divide by the coupon rate. That one will tell you the number of years it shall take in that investment for it to double. For example, if you are investing 100,000 in a bond that is paying a return of 15%, you're supposed to take 72 divided by 15. That will give you something in the neighborhood of 5. So it means 5 will give us close to 75. That's why I'm using 5. It will be 4.9 something. So I'll round it to 5. It simply means by interpretation, it will take 5 years for the amount that you have invested to double. It is after 5 years that you'll have generated and you have built a capital of 200,000. But there is something that is left out in that case. There is an assumption that all the coupons, all the returns out of that investment for the 5 years will not be touched, will not be consumed. It is assumed that everything that is coming from that investment in terms of cash flows, and those are the coupons, are getting reinvested at the same rate. What does that tell you as a bond investor? If you are in long-term investing, you want to build capital that can now in future start giving you a passive income that is enough to live on. If that is an objective, then you should make sure that whatever is coming out of this investment is plowed back to investment of the same return for purposes of the 72 rule. But because the market dynamics keep on changing, they vary from time to time, can either be higher or we will be talking of averaging. The important message here is the incomes that are coming out of this investment need to be channeled to another investment, either to a treasury bill, or if you have not met the minimum threshold for that reinvestment, you can hold that money in another opportunity that is allowing growth. And a good opportunity that you can place that money on or park that money for future reinvestment is a money market fund. The reason, or the opposite in this case of compounding, will be discounting. When you are determining the right price or value, when you are determining the right value price to pay for a particular investment, we look at the future cash flows that we expect from that investment and we subject them to a factor, where a factor is a rate. Then we determine what would be the current value of the future amounts. Then the total is the price that we should pay. The maximum price we should pay in order to make a gain out of that investment will be the total present values of the future values. So in this case, if you're investing in a bond or you're buying a bond, we look at the future cash flows, where the future cash flows in this bond will be the coupons and the redemption amount. Then we subject them to a rate, which is the market interest rate, as a factor, a future factor, an amortized, an unweighted actuarial value to determine the current value. That is what now makes a little bit the process of selling bonds and all this become a little bit complex. And that part has already been done for you by the borrower, the issuer of this instrument, that is central bank. You need not bother much about that. But as in the technical environment, we would want to do such calculations to determine whether we are paying a fair value of that instrument. Then that brings me to the third insight, or for the insight, which is a recommendation that as a DIY investor, you need to do two things. Number one, invest and hold that security to the maturity period. Hold your bond to maturity. The chances of selling at a loss in the secondary market are very high. So purchase instruments that you are willing and you have planned to hold to maturity to avoid selling at a loss. Even when you engage an intermediary to sell that instrument on your behalf, on and above the brokerage fees that you will pay, you will still sell that instrument at a loss compared to how you all have purchased it. For that reason, we now come to the next insight, which is, as a DY investor, ensure you have your personal investment policy statement. We call it an IPS. If you are to engage an intermediary to invest on your behalf, the most important commitment document that I would ask from you is an IPS. An IPS is what gives you your peace of mind as an investor, and most importantly, it cushions you against many risks. And one common risk in Kenya is the risk of getting scammed in the chase of high returns. It also protects or guards your relationship as an investor and your broker or financial advisor. Because in this instrument, you are going to have your risk levels taken care of. You will have your average returns that you would allow or you would appreciate from any investment. So you are anything that comes your way as an opportunity, you align it with your personal policy, investment policy for acceptance. Then that one can give you the maximum amount that you would want to risk on any other opportunity that crosses your way. With the personal investment policy, it guides you on the kind of investments that you would want to take up. Therefore, it's part of the strategies or formal documents that guide the strategies that you want to apply in your investment, targeting at the ultimate price, which is your objective. The other important one is holding multiple CSD accounts or investor accounts. You can hold as many CSD accounts as you want, but it boils down to your ability to manage those different accounts. While you can hold the multiple accounts for purposes of defeating the fund terms, it will be very complex for you to manage the different investor accounts. But owing to the fact that we can divide our goals into 4 parts or 4 elements, where we have immediate goals that I always state they need to be taken care of by your checking account or from your bank account, because those are recurring goals, mainly bills. Then we have short-term goals. Short-term goals can be taken care of by your emergency or your money market fund. Then that one also can also combine your emergency fund with your short-term goals. Then we have medium-term goals, which can be taken care of by the Treasury bills or short-term bond investment, not short-term, medium-term bond investment, because medium-term will range from 1 year to about 5 years. Then we have the long-term goals that would cover over 3 or 5 years and over. So that categorization of your goals now determines which vehicles you would want to assume in your investment. And I'll give you a practical example. Assume this person has 50,000. And because they have not taken the classification of their goals, this individual invests in a cow or a bull in the market. Then 3 months down the line, this person has to settle school fees for a child. You would notice that this individual will have a lot of problem liquidating that investment in a bull, because you cannot chop a leg to sell, because you need maybe a 10,000 out of the value of the bull. We invested 50,000, but the value now could have changed. You will not cut a piece of that animal to sell, because that would result to the whole animal dying. It will obviously means you liquidate the entire investment. You sell the animal, you get the 10,000 that you require, settle that immediate issue, and depending on the market, you may have realized a loss. So what do? You are supposed, as an inside, make sure that you have your goals categorized into immediate, short-term, medium-term, and long-term. Then you match your investments to those goals, their periods. Then that brings me to the insight of holding multiple bonds. Not a bond ladder in this case, although it will come out as a ladder, but you are holding multiple bonds. You can purchase different bonds or multiple bonds of one issue. And that is what now will cure the problem of divisibility of the investment to settle our needs. You have purchased one bond of 200,000. Then a need crops up that requires like 50,000. You cannot liquidate. You cannot take 50,000 of that. You'll have to sell the entire bond, settle whatever you are settling of 50,000, but the 150,000 you may have liquidated a high coupon investment when the market interest rates have gone down, meaning that you have destroyed a good investment. So to do that, you would rather have held 2 bonds of 100 shillings each, so that in the event a problem crops up, an emergency crops up, in the case because not many people are holding emergency funds, you are able to sell one bond of 100,000 and you leave the other 100,000 to term. You are able to liquidate a part of your investment. And that's the reason why professionally we insist that you need to operationalize an emergency fund that is able to take care of such unplanned events, which gives security to your long-term investment. It protects you against liquidating good investments that are within your IPS when the market interest rates are low. Therefore, at the end of the day, the period of investment we divided into 3. We have the certain period, which is now, and that's why all future cash flows, we discount them to the present value to determine whether we are investing viably or not. Then we have the doubtful period, which we cannot be very certain or sure about the events to happen. There is a future period that is totally uncertain. And that is where now the risk in long-term investments comes in. You can never be sure what will happen after 5 years. You can never be certain of what will happen after 8 years, but you can be very sure or almost certain of what will happen next month or 2 months down the line. You will be doubtful of what will happen 6 months down the line, but you cannot be certain. You cannot sure tell what will happen a year or 2 years down the line. And for that reason, that's why on the basis of your personal investment statement or policy, you are able to determine what to invest for the uncertain future when you are using the current parameters. And that's why we insist purchase long-term bonds that you can hold to maturity. But we can play around with a certainty period, which is now in the Treasury bill market. So that also supports your division of your goals into short-term, medium-term, and long-term goals, and you match with the certain, doubtful, and the uncertain aspects of the investment periods. Thank you for watching. Those are the insights that I felt important to share. If there is value in that information, you can share it to another person to acquire the same insights. Engage me in the comment section. Give a thumbs up to that video if it has given value, and subscribe if you are new to the channel.